G'day folks, welcome back to another update for the German DAX and the Japanese Nikkei. Now both are showing still bullish momentum in the longer term, but just be careful on the daily, which is showing a bit of consolidation. We'll include some back testing, which demonstrates how you could have traded using one of two strategies. So don't forget to hit that like and subscribe button to support the channel. In terms of the outlook, the German DAX benchmark German DAX recently hit fresh all-time highs, underpinned by a $46 billion corporate tax relief stimulus for 2025 to 2029 and resilient earnings from key exporters, even amid weak domestic consumer data, while ECB rate cut expectations support valuation expansion, although trade tensions and slowing domestic services pose cautionary tail risks. The Nikkei remains elevated near its late 1980s peak, driven by improved profit margins from corporate reform, massive share buybacks, which equated to about 17 trillion yen for the first half of 2024, low interest rates, a weak yen and attractive valuations. Analysts forecast modest near-term gains despite US tariff threats and first quarter Japan GDP contraction, with consensus expecting a 5 to 7% growth into year end. So for the DAX, we always look at the long-term trends on all our charts. On the monthly, you can see the price is well above the moving average, and so is our CCI 150, which is our main trend indicator. But do notice I've highlighted here a few areas where there's a fair value gap, and a fair value gap generally means orders haven't been filled in those areas. And the way you draw these is when you've got a candle here, for example, you take the candle after and the candle before it, and where you see the wick of that candle, the high of that candle, that's where that bottom is, and the low of the candle after it, at the bottom of that wick there, that's called a fair value gap. You can see here we had another fair value gap there as well. You can see here that massive wick on that candle broke down and covered all those fair value gaps. So that generally happens, let me just zoom out a bit, that generally happens across most situations. Now again, I've highlighted these two areas. They haven't been filled. There's one there and there's one down there. This could take years to play out, so I'm not saying it's going to happen tomorrow, but you can see there another fair value gap was filled. If you go back, that was filled, all these were filled, and that basically happens even back here, all those were filled. So at the moment, those two areas are a bit of a concern. Doesn't mean it's going to happen tomorrow, like I said, but just be mindful of that. If we get a crash, very likely the market's going to drop to that area. On the weekly, in the nearer term, again, I've highlighted these two areas. We've got three fair value gaps in that range there, and I've highlighted that with that big block. And also another fair value gap. Oh, sorry, that was a bearish divergence. I probably should use a different. With these divergence, let me just zoom out a bit. The first one was back here, this long-term bearish divergence, and that was hit in that area there. And the way you draw that bearish divergence is from that high to that low, and that's at 23.38% minimum retrace. So that first divergence was filled, and the secondary divergence we've got, you can see there between those highs are lower on the CCI versus higher highs on the price. Now if I was to draw a Fibonacci on that one, we take from that high and I'll take it back to the recent low before that divergence started, significant low. So that'll probably be in that area there. And what we do now, it's going to get a bit messy maybe, but we take the 23 to 38% Fibonacci retrace, and what I'll do is I'll mark those, one of those ranges, I'll mark them as a different color. So I might mark that as a red color, and we'll keep that as blue, which was our original. Let me just mark that, it's a bit slow at the moment. I'll fix these up another time. So that there is a fair value gap, and that's our divergence. So as long as the CCI keeps dropping, and we might see a bit of a pullback from where it is at the moment. Of course, the price can keep rising. It's currently bullish, but just be mindful of a bearish momentum to the downside. That's on the weekly. On the daily, we've got a similar sort of pattern happening. Again, these are all independent from different time frames. We've got a potential bearish divergence here. I'm going to call that a double top or a triple top on the CCI versus higher highs on the price. And if that was to pull back, similar sort of situation. Take it from that high to that low. again, we've got another 23-38% range there. And these other areas here that I've highlighted in blue also, I should probably change the color coding, but they're also fair value gaps, and that coincides with this Fibonacci retrace of a divergence. So again, there's a fair value gap back there. I've stretched it out to the current period. That one there was filled. This one here is yet unfilled. That one there was filled. You can see with that wick there. We've had a few fair value gaps there. They were all filled. Even that was the latest one there. But these ones back here remain unfilled, so we might see a bit of a retrace back down to that. And that also coincides and aligns with the weekly trend. Now, if we look at the intraday charts, again, be mindful we've got predominantly long trades to be taken, but you can see here we've got a fluctuating CCI 150, which also seems to be moving in line with the price. Now, there's no divergence there. You could argue that was a bullish divergence, but there's, again, you can notice there that higher lows and higher lows, so no divergence there. That was a bearish divergence back there. You can see the highs there are increasing versus the highs here are declining. So that was a bearish divergence. And again, what we saw there was a Fibonacci retrace, and it broke right through our 23-38% minimum range. So always pay attention to divergence. And the way I use divergence, I don't trade them. So if you're going long during this period, for example, and you started seeing bearish divergence, there was another one back here that filled it quite easily. If you start seeing a bearish divergence, that's where you probably take your profits and stop trading long positions and wait for new trends to develop. So in terms of backtesting, we've got here the stop loss approach is the top chart here, and this one here is the average down approach. So what we do with the trading strategy, this is a 1 hour time frame, we take the direction of the daily. So if the daily is going strong, bullish, like it was back here, we take long trades. So what we do on the 1 hour time frame, I'll just demonstrate here on the daily, when the CCI breaks above the moving average, and also the price breaks above its moving averages, we take long positions on the 1 hour. So you would have taken long positions on the 1 hour based on that method, and you let it run, and you close out the positions when the CCI on the daily breaks into that moving average range. So you would have closed it out on that candle back there, which equated to about this area here. So you had a few positions open here on the average down, and it started to have a bit of a drawdown. But again, using the method there on closing it out when the daily breaks into the moving average range, you would have closed out your positions. Also, in a micro level, whenever you see these declining CCI tops, like we did back here, for example, versus higher highs on the price, you should ideally stop trading, because here you might have seen and we did see a slight retrace to the downside. Now this one kept rising, it's hard to see there, but it kept rising. And if you were to draw a Fibonacci retrace on that one, you would have taken it back to that low. Now in this case, it failed. So they don't always work, but more than 90% of the time they do. So that would have been a successful or an unsuccessful divergence. Now, that's even if you stretched out the divergence, they were still lower highs than that point there. Let me just go across there until such time as there, and that still probably wouldn't have worked. And if we stretch that out to that point there, you can see that still didn't touch the 23%. So that was actually kept going actually. So we might have, even that low there is still in play. Yeah, that would have been an unsuccessful divergence. So let's not push it. I like to take them with small areas. Don't get too cocky and go too long, too far into the chart with it. But again, had you let the stop loss approach work out the whole purpose, the whole process, you would have averaged down in a bit of a drawdown there. But again, I don't suggest you do that. You always pay attention to any divergence, but especially if the daily breaks into the CCI. But had you let it play out the whole period, the stop loss approach generated 6,303 roughly, and the average down generated 40,343. So the Nikkei on the long-term trends, first off, it's actually broken into that moving average range on the monthly moving averages on the price, And you'll notice the CCI has dropped below the moving averages, so we might see a bit of a pullback on that, or it may have already played out. Now you'll notice here, for example, those massive wicks on those 2 months have dropped down almost to the same level. In fact, they have at around 30,320. It's actually a triple bottom there with those 3 wicks there. But the CCI is still declining, so somewhat bearish momentum to neutral on the monthly. Also, and that was a result of this bearish divergence, a very narrow bearish divergence, so we possibly may see further downside. On the weekly, I've got here, that's also into that moving average range, and the CCI is broken just above the moving average range of its chart. But again, that was also another bearish divergence, higher highs there versus lower highs there, and the CCI kept dropping. We had initially a drop there, broke into our target range, bounced out of it, and then we've got another bounce to the downside. Now what I've done here as well is I've highlighted in red the fair value gap. So we might possibly see a price retrace to that level in the coming days or even weeks or even months. Sometimes these take a while to play out. And you'll notice there was a fair value gap there, but that wick, you could argue that's already been penetrated. These back there were penetrated with this activity. And back here we had other fair value gaps identified there, and they were all being filled with these previous candles. So at the moment, in terms of trend, the price is hovering in that moving average range, and the CCI is just broken just above it. Somewhat consolidation at the moment on the weekly. On the daily as well, we had on both moving averages, they're very narrow, showing a lot of consolidation on the price as well as the CCI. Undecided yet. And you'll notice here we had a few fair value gaps. That one is filled by those candles. These ones down here were filled also with that wick. Now we've got a few down here that were possibly filled as well. That was filled. So no real threat on the daily on the fair value gaps there. But again, just mindful. The CCI tops are dropping, and so is the price. So we might see, and that just shows a continuation of a downtrend possibly, but a bit of a consolidation at this point. So just be careful about. I'd wait for a confirmation of either a break below strongly or a break above strongly to confirm the trend either way on the daily. If we go to the 1 hour chart, let's go to the 1 hour chart. Now again, we would have taken the long trades during that period according to the daily, but notice here on the 1 hour chart we've got a couple of things happening. We've had a bearish divergence first off versus higher highs on the price, and that bearish divergence broke down quite easily into our 23-38% Fibonacci range. It went as far as the 50% level, and again it's been consolidating in that range. But notice the CCI is still dropping, even though it's breaking higher than the moving average at the moment. I would be cautious about going long until the daily showed a convincing break higher. So just be careful of that. So apart from the divergence, also note here we've got in red, I've highlighted, if I zoom in, I've highlighted a fair value gap. So we might possibly see a break to the upside, and if it does, at the very least a wick will break into that range to fill those orders. Back here we've got another fair value gap which hasn't been filled yet. So it could go either way, just be very cautious, or it could go both ways, to be honest. It could actually spike up and it could actually fall to the downside, or vice versa. That's how you read these fair value gaps. So again, all those fair value gaps in that range were filled with this activity. I won't go further back there, but you get the idea. That's where we are at the moment. So it could go either way, and that's what I'm saying. Just wait for confirmation on the daily to take any trades. Now, if we go on to the back testing, we're going to demonstrate here where the price broke above the moving average, and so did the CCI. And that's where we've taken the stop loss approach and the average down approach. So again, similar to the German DAX, we had a couple of bearish divergence. We've got almost a double top or a slightly lower high here on the CCI versus higher highs on the price, and that fell off. So that's where you would have ideally, once you started noticing, that would have been your first area of noticing a bearish divergence, where that high dropped off. First point there. So you possibly should have taken your money off the table and taken your profits. But at the very latest, you should have taken profits when that CCI on the daily broke into that moving average range at that point there. And that equated to about this area here on the 1 hour chart. But also notice here the CCI dropped quite strongly, and so did the price. Didn't drop as strong, but it did drop. And you would have taken some profits at that point. The stop loss approach, had you let it run through the whole period, generated 5,680, and the average down so far has generated 66,290. But again, notice that drawdown. So ideally, more recently, you had this bearish divergence. As soon as you saw that, you would have taken your profits off the table at that point. Straight after that divergence showed. That's what I'm saying. Always pay attention to divergence. Back here, you had a bullish divergence, and once it broke higher, you could have actually entered long positions at that point again. That also coincided with the break above the CCI as well and the price on the daily, so that would have been an ideal spot to go long. And again, once you notice that bearish divergence, as soon as you saw that second peak drop, you would have taken your money off the table. So if you're new to trading, we're including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily trades. If you're new, and if you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.